Okay, if you're trying to buy a home in Canada, you know the drill. The down payment, it's the biggest hurdle, right? Well, what if I told you that hurdle just got a whole lot lower? You're going to want to listen up because the biggest mortgage reforms in a decade are here, and we're about to break down exactly what they mean for you and your wallet.
Let's be real, for most of us, especially if you're in a major city, that 20% down payment, it feels, well, impossible. It can mean saving for over a decade, just to get your foot in the door. It's the single biggest barrier to owning a home, plain and simple.
Okay, so let's get right into it. The federal government has just announced two game-changing new rules that are designed to tackle this exact problem head-on.
And let's be super clear here. We're not talking about minor tweaks. No. These are being called the most substantial reforms in over 10 years. So if you've been sitting on the sidelines watching the market, well, this is your cue to lean in and pay very close attention. So change number one, a huge increase to the price cap for an insured mortgage. You know, that cap has been stuck at $1 million since 2012. It's basically locked out buyers in places like Vancouver or Toronto. But now, that cap is jumping up to $1.5 million. This is going to reopen the door for thousands and thousands of potential homeowners. It's a big one.
And the second game changer? This one's about your monthly payments. For the first-time home buyers can get a 30-year amortization period on an insured mortgage. Up until now, you were capped at 25 years. Why does that matter? Well, it gives you a ton more breathing room in your monthly budget. And stick with me because we're going to look at the exact numbers in just a minute.
So I've said insured mortgage a few times now, and you might be wondering, what exactly is that? To really get why these new rules are so powerful, we've got to do a quick breakdown of what mortgage insurance is and how it all works.
Okay, here's the detail that most people get wrong. This insurance, it doesn't actually protect you. It protects your lender. Now, why would you pay for that? Well, because it removes their risk. The law says, okay, you can give this person a mortgage with less than 20% down. So yeah, you pay the premium, but the benefit is massive. You get into the housing market years, maybe even a decade, sooner.
In Canada, there are basically 3 places that provide this insurance. You've got the government-backed one, CMHC, and then 2 private companies, Sagen and Canada Guaranty. But, and this is the only part you really need to remember, it doesn't matter one bit which one your lender picks. For you, the buyer, the cost is the same, the rules are the same, it's all identical.
Okay, so if this insurance is mandatory when you have a smaller down payment, the big question is, how much does this thing actually cost, right? Let's break down the math. It's simpler than you think.
So the premium is just a percentage of your total mortgage amount, and the rate you pay depends on what's called your loan-to-value ratio, which, is just a fancy way of saying how big your down payment is compared to the home's price. The rule of thumb is super simple. The smaller your down payment, the higher the insurance rate you'll pay. That's it.
All right, let's make this real with an example. Let's say you buy a place for $900,000 and you put down 10%. So that's $90,000. That means your mortgage is $810,000. Okay, so looking at the chart, that puts you in the bracket where the premium rate is 3.1%. You just multiply those two numbers together and your insurance premium comes out to just over $25,000. But wait, and this is really important. You do not need to write a check for that 25 grand. Whew, right? The good news is that premium just gets added to your total mortgage balance. It's rolled right in, and you just pay it off slowly, bit by bit, over the entire life of the loan.
Okay, so we've covered the nuts and bolts. Now for the fun part. Let's tie all of this back to those new 2025 reforms and see what this actually means for your buying power. This is where it gets really good.
This is where it all clicks. Think about buying a $1.2 million home. Before these changes, you needed a staggering $240,000 for the down payment. For most people, not happening. But now, with these new rules, that exact same home is eligible for mortgage insurance, and your minimum down payment, it drops all the way down to just $95,000. I mean, come on, that is a massive game changer. Now let's talk about that second big change, the 30-year amortization. It's pretty straightforward, right? You're just spreading the same loan over an extra 5 years. So naturally, your monthly payment is going to be lower. In fact, what we're seeing is that this simple change can chop about 10% off your payment. So what does 10% actually look like in real money? Well, let's take a typical $700,000 mortgage. Just by switching from a 25-year term to a 30-year one, you could be saving around $330 every single month. That's almost $4,000 a year back in your pocket as extra cash flow.
So when you put it all together, here's the bottom line. The higher price cap helps you clear that massive down payment hurdle just to get into the market. And then, the longer amortization makes it more affordable for you to stay in the market month after month. This 1-2 punch fundamentally changes the entire landscape for homebuyers in Canada. So that leaves us with one final question for you. With these new rules, how has your path to owning a home just changed?